For the first time in history, not a single U.S. bank was involved in two major Canadian bond deals, Ontario's $2 billion offering and Alberta's $4 billion megatender. Instead, European and Canadian banks like Barclays, RBC, and CIBC took the lead, signaling a seismic shift in North America's financial landscape. This wasn't just a minor market adjustment. It was a deliberate snub to Wall Street, driven by escalating U.S.-Canada trade tensions. The message was clear. Canada is no longer content relying on American financial dominance. Behind the scenes, the move sent shockwaves through Bay Street. While the bonds sold quickly and smoothly, the absence of U.S. banks raised a critical question. Was this a temporary political statement or the beginning of a long-term decoupling? The shift wasn't limited to bonds. Alberta had already set the stage months earlier by excluding Bank of America from a €4 billion denominated deal, opting instead for European investors. Risk managers in Calgary watched closely, knowing that this wasn't just about diversification. It was about survival in an era where Washington's policies could disrupt capital flows overnight. The repercussions extended far beyond bond markets. Ottawa quietly accelerated efforts to reduce reliance on U.S. supply chains, dusting off old trade plans and redirecting exports toward Asia and Europe. Vietnamese brokers suddenly appeared at Canadian logistics conferences, while Brazilian port deals gained new urgency. Even procurement rules were rewritten. U.S. suppliers now faced exclusion unless no alternatives existed. A Stockholm-based IT firm, for example, unexpectedly won a contract over a Seattle competitor, proving that cost wasn't the only factor anymore. Meanwhile, the financial infrastructure supporting U.S.-Canada trade began to fray. Currency traders noticed a troubling trend. U.S. dollar liquidity dried up faster in the evenings, forcing firms to adjust their hedging strategies. Small businesses, like a Montreal insulation manufacturer, reconsidered cross-border investments, shifting focus to Saskatchewan over Ohio due to financing uncertainties. Even Wall Street, which had long taken Canadian deals for granted, felt the sting. Missing bond commissions might not make headlines, but they left a gaping hole in year-end profits. Alberta's energy sector, always a bellwether for Canada's financial health, took the boldest steps. New oil export routes bypassed the U.S. entirely, targeting Asian markets, and financed through European insurance consortia. The goal? To break free from the dollar's grip. But the strategy came with risks. European investors, wary of climate policies, hesitated to back projects that clashed with green finance rules. The big question now is whether this shift is permanent. U.S.-Canada financial ties run deep, with nearly $1.5 trillion in cross-border investments. But trust is eroding. Bay Street's risk models now prioritize the European Central Bank's data over the Fed's, and London banks are opening more Canadian sub-accounts than ever before. The financial Cold War isn't just coming, it's already here. So what happens next? If Canada succeeds in building alternative financial pipelines, it could emerge stronger and more independent. But if the transition falters, the economy risks getting caught in the crossfire of a U.S.-led backlash. One thing is certain, the days of automatic reliance on Wall Street are over. What do you think? Is Canada's move a smart hedge or a dangerous gamble? Let us know in the comments. And don't forget to subscribe for more deep dives into the forces reshaping global finance.